Hi, today I'm going to teach you more about the topic of technical trading indicators. And by the end of this video, you should know what the most useful technical trading indicators are and how you can use them in your daily trading practices. And I've personally chosen to teach you more about this subject because I think trading indicators can really help you to establish a very informed trading decision. They help you shift from having a feeling to having an actual argument supported by data. And today I will be talking about the five most important technical indicators, that I personally find most useful in trading. But before we get into that, what are technical indicators? A technical indicator essentially is a tool that takes raw market data, think about price, volume, volatility, and they can turn it into signals, patterns, and graphs that are much easier to interpret. And they don't predict the future, but they do help you assess trends or momentum and potential entry and exit points in a much more structured way than just by looking at the price charts. However, important disclaimer, please be aware that the time frame you choose has a very significant impact on what an indicator tells you. The same indicator can give you different signals depending on what time frame you use. So having said that, let's move on to the first one, which are moving averages. And these are lines that you draw on a chart that track the average price of a security of a certain period. And you can personally choose what kind of period you want them to represent. But usually swing traders use the 200 and the 50 period SMA to assess a trend, or when they cross to assess or identify a potential change in the trend. And I already touched on it a little bit. There are two kinds of moving averages. You have a simple moving averages, where all the data points have an equal weight. And then you have exponential moving averages, EMAs, where the more recent data points are weighed heavier to make them a bit more responsive to new data. And an example of how you can use this is, for example, let's say the price of oil is currently trading at $60 a barrel, and both moving averages are above this, let's say 65. That means that the current price is trading lower than the average of the past 50 and 200 periods, and that would indicate a downwards trend. And if the current price is above the moving averages, that would indicate a potential upwards trend. And when the 50 and the 200 periods cross, it could mean a potential change in the trend. And usually for moving averages, you move on to other indicators, for example, MACD, which stands for the moving average convergence divergence. And this indicator is also used to assess trends, and it has several components. For example, you have the MACD line, the signal line, the zero line, and the histogram. The MACD line is a 26 period EMA minus the 12 period EMA. The signal line itself is a 9 period EMA of the MACD line. And then the histogram shows the difference between the two. So for example, if the histogram is positive, the bars are positive, that means that the signal line is above the MACD line right now, and that would indicate a very strong recent momentum. So that could be a bullish signal. And when the bars are negative, the opposite would be the case, and that would be a bearish signal. And usually from RSI, from MACD, you would move on to RSI, which is the relative strength index. And this is a so-called momentum indicator um, that measures the speed and the magnitude of a security's price change, and it can detect overbought and oversold conditions. So, for example, um, it's essentially a line that oscillates between 0 and 100, and when it's above 70, an asset is usually considered to be overbought, and when it's below 30, an asset is considered to be oversold. So below 30 would be a bullish signal, price might go up, and above 70 could be a bearish signal, the price might go down. And to confirm this, you usually go to the Bollinger Bands, and these are tools that can help investor and traders as well, especially traders actually, gauge market volatility. So this indicator has three lines. In the middle, you have your 20-day SMA, and then you have a line, a standard deviation above it, and you have a line, a standard deviation below it. And the outer bands, they expand and contract depending on the volatility. So if the volatility is really high, uh, the bands will expand, which could indicate a persistence in the trend and in the price essentially. And if they narrow the outer bands, that means that there's less volatility, but that there's potentially a chance for a breakout. And also, investors look at if the price is close to the upper band, it might be overbought, and if it's close to the lower band, it might be oversold. But I have to say, traders usually don't really use Bollinger Bands as a primary tool, but more as a secondary tool to confirm the RSI and to confirm the MACD. And let's move on to the last one, VWAP, which is the volume weighted average price. So this is the average price adjusted for volume for just one day. It resets every single day. For example, if there are two transactions, one is for $10 and the other one is for 12, the average price of that is $11. But let's say the $10 transaction is for just one share and the $12 transaction is for 100 shares, VWAP would be 11.98. So, and traders often use this to determine trends. So, for example, when the price is below VWAP, it would be considered to be undervalued, and when it's above VWAP, it would be considered to be overvalued. So that's it for today's overview of the most essential trading indicators. But remember, none of these should be used alone in isolation. Always combine them to come up with a very good trading decision and a trading strategy. And just as important, remember that no indicator is perfect. No one is 100% foolproof. So please manage your risk. But that's next week's topic. So keep practicing with these, and you will become much better at spotting trends and momentum, entry and exit points, and yeah, use them to your advantage. And I wish you the best of luck in your trading endeavors. And well, thank you for watching, and see you next time.